The broadcast is now starting. All attendees are in listen-only mode.
Good evening, everybody. How are we all doing?
I am good.
It's good to see everybody. We're going to give people a couple minutes to get in. Plan on starting at 5 after. But if you can't hear, if you can hear me, just give me an A-OK or something in the chat. Good. All right. We'll be going about 5 minutes. All right. How are we all doing? About ready to get going? Great. So here's what I'm going to say. If you have a question that is extremely pertinent, please ask. Otherwise, wait until, at certain points, I will ask if people have questions. Write down your question and load them up when I ask. That way we can get kind of a smoothness to the event. So, welcome to VXX Made Easy. What is the VXX? My name is Mark Sebastian. I am the founder of Option Pit. And now, what is Option Pit? We are an education company and consulting firm that works with individuals, teaching them how to trade like a professional. And then we do consulting work for RIAs and some small funds, helping them implement and test option strategies. So lots of fun work. And we really enjoy working with the retail public because we get the chance to really show them how a professional thinks. Andrew?
I agree.
Thank you. My name is Mark Sebastian. I've been a trader for, oh geez, we're getting near 20 years now. It's 17 years. I started in 2001 in New York on the Amex, and then ended up on the SIBO. And then after leaving there, I started Option Pit, as I also run a couple of small hedge funds. I am joined by my chief options strategist, who is Andrew Giovinazzi. He was the managing director of Group 1 in Chicago before starting his own trading firm. And he ran his own shop for what, close
5 years?
10,
Nope, 5 years.
Yeah.
And then Citadel and everything. So
yeah. So he's forgotten more than most people know about options. And we're here to talk about VXX. So for starters, I want to remind everybody this is for educational purpose only. This shouldn't be considered investment advice. Options have risk. Consult a financial professional with questions. Let's begin. So what are we going to cover? We're going to talk about what is volatility. We're going to solve the January 2018 riddle of VXX. We're going to talk about what is VXX, what moved VXX, and how to trade profitably. Now, you're going to hear a lot about VIX because VIX and VXX are cousins. And to understand VXX, you need to understand VIX. So believe me, we will get there. What is volatility? Well, it can be, I've got an uncle that has a volatile personality. My wife can have a volatile personality. And so, and what does that mean?
Normally,
well,
but not normally.
Not normally. No, she's generally even keeled. But volatility is just really change. It's how much movement you have, emotionally or performance-wise. Weather can be volatile, right? You have tidal waves. Waves can be huge or they can be tiny. Last summer we went sailing on Lake Michigan, and one day we had these massive waves, and literally the crew sailing was scared. And then, 2 days later, there was almost nothing. Weather can be volatile. It can go from raining to explosive. But what kind of volatility do we care about? The answer is stock and index and underlying volatility. So volatility is simply the measure of movement or lack of movement. For stocks, ETFs, indexes, we'll look at historical or realized volatility. And historical tends to look at kind of where did this close yesterday, where did this close today. Doesn't capture everything, but it captures most. Historical and realized volatility can be used interchangeably. However, we tend to use realized as short-dated volatility. Historical volatility is kind of the long-term trend of the underlying. So let's take a quick look at historical volatility and what it might look like.
Right before there.
Where did you put the chart for that? Here it is.
Oh, there it is.
Thought we were moving this.
I did, but I moved it to the wrong place.
Clearly. So this is historical volatility, and that's what the underlying did. And that is the white line, which we would call kind of realized volatility, is what happened in the last 10 days. And you can kind of see the explosion that we had in January and February. and kind of the secondary explosion we had at the end of February and March. Then the gray line is 30-day historical volatility. And that's kind of what's happened over the previous 30 trading days. And that's much more consistent and gives you a much better view of the real trend. 10-day vol can move very quickly. 30-day tends to move a little slower and give us a much better idea of kind of what's happening.
Kind of looks like the Grand Tetons.
It kind of does.
Kind of does.
Mm-hmm.
All right, so we're going to go. I got to get rid of all my drawings. So.
All right, so what is implied volatility then? Implied volatility is the market's best guess at what is going to happen. All right, what is going to happen? Now, do we know what is going to happen? No. So what implied volatility represents is kind of the market, the buyer, where buyers and sellers meet. It's where the demand for an option and the demand to sell an option meet up. And that kind of, it means, you know, when you have kind of equilibrium, it's just like Vegas betting. It's just like taking the money line on a sports bet. The money line is determined by buyers and sellers, and it is the market's best prediction of what's going to happen with the outcome of the game. You know, the point spread, same thing. Point spread moves as there's more or less buyers or sellers of a team. And implied volatility is just the point spread before the game. That's a really good analogy.
I like
so
that.
When implied volatility is high, think of it as like, you know, the spread between the Patriots and the Cleveland Browns. When implied volatility is low, you could think of it as the spread between Minnesota and the Eagles, something like that. Two good teams. So, Andrew, why don't you kind of embellish upon that?
Upon the implied volatility. So what Mark just said was there is a, you know, when we looked at the picture above here, it's what the option demand is, right? So this is everybody. This is I keep asking. This is Randolph, right? With the phone wanting to buy some options. Okay, that order goes to the pit, and there's a couple of traders. I don't know how old all of you are, but that's Eddie Murphy and Dan Aykroyd in Trading Places. One of the best trading movies of all time, probably. Okay, and they're deciding whether they want to buy or sell the options that you bring into the pit, and that interaction generates what we call an implied volatility. It's a mark on volatility. It's a price. So how do we follow that price, right? So that is a price of the options that actually is not the option price. It is the measure of how much the market expects the option to move over a given period of time. So early in the year, we saw implied volatility in the 20 percentile range or higher. This is a 6-month chart of the S&P 500. Recently, we've had the implied volatility go into the single digits. Over here, earlier in the year, we had a little bit more we had lower volatility, and it spikes up. So what you get the idea is implied volatility moves just like the S&P 500 moves. Now the correlation is the opposite. We're going to talk about that in a little bit. Meaning, you know, the implied SPX goes up and the implied volatility goes down, and the SPX goes down and implied volatility goes up, right? Then it got really choppy in here, right? This was kind of we'll just call this the angry February time, right here, where we had these massive moves, probably 100 handles per day. We kind of worked our way out of it, and notice as we worked our way out, SPX goes up. The implied volatility of the options, basically demand for options, went way down. Okay. Also, remember from the earlier slide, right, is the measure of the underlying movement. So implied volatility measuring the movement means the market was moving a lot less. So you have SPX going up and implied volatility going down, down, down. Notice how we had these huge candles, right? Massive, massive daily moves. And then all of a sudden the candles got really small. And as soon as the candles got smaller, the implied volatility went down. Now you got a couple of big candles again. The market starts falling apart. Implied volatility goes up. Then things kind of settle a little bit. The candles get a little smaller. And then implied volatility is on its trip down. And usually here we've had the market rally. And now it's kind of flatlining around 2,700 seems to be the magnet, right? And as SPX consolidates around 2,700, I know we're very close to it, the implied volatility is kind of dying. Now, we did have that kind of one big down move on Tuesday this week, which shot vol up again. So what you can see is the SPX moves and the demand for options move with it. So if you're going to trade a product like VXX, what you have to understand is what makes volatility move and what makes a product like VXX move. Okay, so this is something that I figured out to explain. And I actually saw somebody posted this on Six Figure Investing. Some fund posted literally the exact same thing that I did. I think I worked this out with Mark like 6 years ago when we did our first VIX webinar. Okay, is how do you think about VXX? What makes it go? So if you're going to trade options on the VXX, which is what our webinar, the VXX Made Easy series is going to specialize on, is if you want to trade options on the VXX, you're trading them on an ETN, which we already know is a derivative, but that ETN trades from the VIX futures. Those VIX futures trade from the VIX index, which come from the volatility of the S&P 500, the implied volatility. And that cash index, all of that is trying to predict some sort of forward volatility. So if you look at it, if you've looked at VXX and been confused by how it moves, what you have to understand is you have to understand it moves through these levels. Everything gets filtered through another level. But once you understand how the filters work, it's a whole lot easier to trade the product. Like much easier. Like so much easier, it's going to be hard for you to believe it after you take the class. So what I've done is I've set up this kind of, the trail of the VIX, what it looks like. So what I do is we start with sort of how the S&P 500 trades and understanding really how realized vol works. Okay, that translates to the S&P 500 options and then the volatility of those options, right? Just measuring how much the market expects them to move every day, okay? That creates the VIX, and the futures trade on the VIX. Now, once you're at the VIX futures, you have two choices. You can trade the VIX options, or you could trade a product like VXX. If you trade a product like VXX and then you want to trade the VXX options, you're here. Then you have a trade. So literally what you think about is look at the steps you have to take in order really to trade the product properly. So if you're trading Apple, you're like, I want to buy Apple options. I want Apple, I think, is going up. I want to get long. It's really simple. The problem is if you want to buy volatility, if I want to buy VXX, you have to understand all the things that make VXX run, right? And it's a process. The thing is the stuff that makes VXX run is relatively predictable. You can predict it, you can price it, you can figure it out.
There is math to where VXX is going to go.
There is some math.
It's. I know it sounds crazy. Very few products actually mathematically tell you, if things are like they are today, here's where we will be
tomorrow. It's amazing.
VXX does that. It's amazing. So that is one of the key things that we really work with our students on. So let's take a look at VIX and IV, Andrew. This is the VIX. Now, what is the VIX? It is It's kind of like the S&P 500 for option pricing. You know, the S&P 500 is kind of a barometer for whether the market is going up or down. VIX is a barometer for whether there's demand for options or not. And it is derived from buyers of and sellers of options on the S&P 500. It's essentially the implied volatility of an option that always on the SPX that always has 30 days to expire. So if you held every option of value on the S&P 500 with 30 days to expire constantly, that would be the VIX would give you that measure. So why 30 days? Well, when they developed the VIX, that was all that was available. The calendar is it's very important. Now we've got dailies. You know, when I was trading SPX, we had 7 expirations plus we had maybe 5 expirations plus another 5 or 6 leaps. Now they have 5 or 6 expirations a week. Not quite that, but there's a lot of expirations. So, you know, that's the key. And most importantly, it doesn't measure anything. Now, it's tangentially moved by movement of near-dated options, but it doesn't measure options that expire this week or next. It measures options that have 23 to 37 days to expire. Now let's talk about how futures move. And
there you go. So the next part is the thing that makes, if you recall, right, where is VXX on this trail, right? Between VXX and the S&P 500 and VIX, there are these futures. So part of what goes into the value of VXX is where the VIX futures are pricing, right? Because it's a part of the chain. The VIX options are a little part of the chain because that helps with the implied vol. But what you're looking at really is where are these VIX futures trading, because that directly impacts where VXX is going to trade. So what I do is you've got to learn some basic future trading, meaning this curve here is all of the VIX futures at a point in time. So if the VIX cash is trading 1455, you have futures trading 1565, 1617, 1616, all that kind of stuff up there, right? So you've got the futures at higher prices up here, and you have VIX cash down here. So if VXX actually trades these futures, which we're going to find out, what happens to them on a daily basis? So for all of you that trade options or anything that decays, right, where do these futures have to go every day? Every day that goes by, where do these futures go? Right? Where do these futures go on a daily basis if the VIX cash is trading here? So this is a basic principle when you're trading VIX futures. Where do these things go? Right? Are the futures flying up, or are they gravitating toward wherever the cash is? See, this is where you can type something in to the box. You go, okay, you know, I want to type something in and see. Are the futures flying up, or are they moving toward the cash? Thank you, Virginia. They're moving down. Right? So the first thing you have to learn about trading anything that trades or that is priced off the VIX futures, you need to figure out where the pull of gravity is on those futures. That's number one. You also have to figure out the speed at which they're pulling down. So you can actually price that. So Mark and I have spent a little time thinking about and pricing how those futures move relative to the cash moves. So what's important is, as you think about this, even if you have an opinion on where the VIX cash is, it doesn't matter when you trade a product like VXX, if the futures are trading way up here over where the cash is. Because what happens is this can dampen the move of VXX. Because right, VXX owns these futures, which you're gonna learn. So trading a volatility product, you have to be very, very certain about what you're trading. It's like if you buy a time spread, if you buy a strangle, a straddle, whatever you do, if you sell options, you have to be pretty certain what that underlying is. So one of the most important things about trading VXX and a product like it is you have to be dead certain what the underlying of the product is. Okay?
Yeah, you know, that's the key is you can think VIX is going up and then buy VXX and still lose money. There's a math behind how much it's going to go up and how much it's going to go down with different movements in the VIX futures. All right, so now let's talk about how one could have seen and predicted in January 2018 what was going to happen in February. So who remembers the show Sesame Street? You might have heard of it. It's a little-known kids show that airs on PBS. Not many people know that one. All right, well,
I remember.
Yes. There used to be a song, yes, the Cookie Monster. There used to be a song called One of These Things Is Not Like the Other. All right?
Are you grabbing the Cookie Monster right now?
No. Here's the song.
Oh, I can't hear it, Mark. You got to put your mic onto the speaker or something.
Well, you can barely hear it. All right. Anyway. So, anyway, the song is One of These Things Is Not Like the Other.
Someone is choking Big Bird.
Yeah. And it's One of These Things Is Not Like the Other. And that's usually the way it is, because normally when SPX is going up, VXX should be going down, SPX IV should be going down, and VXX IV should be going down. When SPX is going down, VXX should be going up, SPX IV should be going up, and VXX IV should be going up. So what I want to point out and what we want to really show you is what is happening in this picture here. All right, in picture 1, you can see SPX is going up. In picture 2, you can see SPX IV is going up. Excellent labeling.
Thank you.
In picture 3, you can see that there's actually VXX is starting to go up. Picture 3, it's at a minimum flat, but really toward the end it starts to rally again.
It does. And it did.
Yeah. In picture 4, VXX IV is going up. So what is going on here? All 4 are rising. What do you think that means when one of these things is exactly like the other? You know, that's even worse. You know, if Big Bird was singing One of These Things Is Exactly Like the Others, you know, that's telling you that there's a real problem. When the market rallies and volatility rallies, that tells you that people are getting scared. And smart money is getting scared. When smart money gets scared, there's a reason to pay attention.
Right. Usually the vol traders are pretty smart. Right? Because they have to take the other side of everything.
Yeah. So the vol guys are usually the same people that are doing bonds and credit. And those guys are just light years ahead of everybody. So you really have to be careful when that starts to happen. So Andrew, kind of what happened?
So this is one of the things that we use at Option Pit, and that which you'll learn in gory detail, but it'll be very helpful, is what happens is sometimes there's this time has value for volatility, or let's just put it this way. Volatility is equal to the inverse of the square root of time. So what that means is volatility over time should be worth more money, real simply. So what happened is into January 16th, which what I would call was probably the last day until mid-April, that volatility even acted semi, what I'll call normal in contango, which it is most of the time. This cash price got very, very close to this future price. Basically what this says is, with 30 days to go, the market wasn't valuing volatility at a premium anymore. So when we do the VXX Made Easy, when we have more time to discuss the nuance of it, the market doesn't like that. What this usually signals is that people or the vol traders are very uncertain where the price of something is. They're charging a premium for the futures, but not very much. And what this does is this sets off a chain of events for creating option positions, for understanding how a product like VXX might trade. So you've got to, what we do is we'll teach you essentially how to read the futures, right? And I said this at Option Insider Radio today. It's the easiest on the option block. It's the easiest thing to learn, and it's the best misunderstood market pricing tool there is. So
agreed.
When this cash moves really close to the future, the market is like Danger Will Robinson. Something is not right because the market's not pricing volatility properly anymore. They don't know how to price it. And we got very, very flat into January 16th. Vol got this volatility, I guess the VIX volatility, rose up a lot relatively quickly, and the futures didn't respond. They didn't respond by saying, okay, well, volatility is going to be higher later. We just don't know where things are. Okay, so what I've learned is watching this future curve for the last 6 years is it moves in fairly predictable ways. So you just have to understand how it moves. And one of the things I'll tell you, one of the takeaways from this webinar, if you're like, okay, well, you guys gave this webinar, it's 9:30 at night. The thing to learn is once this cash to VIX future gets very close, that's generally that's a danger sign in the market for yourself. So if you're short iron condors or you're short this, short that, I would be looking to close, reduce, or something like that, because this is the market telling you something's not right. Okay. And we'll show you multiple instances of that in VXX Made Easy. Okay, so what happened? All right, so the day before January VIX expiration, okay, the VIX cash got way too close to the longer-term futures for too long, which at Option Pit, that's usually a danger sign. We can show you a ton of examples of it. Almost all of everybody in Option Pit knows that by now, but for whatever reason, nobody catches on to it. Either I guess they just don't want to do the work to learn it. But the VIX cash got too close. And what Mark said earlier is the rising SPX was not in sync with VIX volatility going up. So when we go through this with VXX Made Easy, you'll see like the math behind it. So when the math isn't working out, that means the market is adjusting in other ways. They are making adjustments to volatility. They're lifting volatility because they're not sure. That's the most important thing. So when the liquidity provider, Mark and I were both liquidity providers, when you're not sure what's going on, what do? You crank up the vol. So remember this, right? This is the sum total of all participants in the S&P 500 in volatility, in VIX, the whole vol complex. This is the sum total of all their opinions. That's why it's important. Okay? So, also what's important is VIX was in contango, but it was very light. When I say light, that means the cash and the futures were very close. In general, what this means is we have higher realized vol. So when Mark was talking about realized vol earlier, how much the S&P 500 is going to move on a given time or over a given time, this is also telling us that the market's expecting a lot more volatility than we're seeing right now. And I can show you what's happening right now is the chart of volatility looks exactly the opposite of this. Okay, at least today. There's just not a lot of action right now. So that's a different type of trade. Right? So when you look at the SPX and you look at what's going on with the SPX right now, this is kind of where we are. We're hovering around 2,700. We have lower volatility. We had much higher volatility here in the 30s. Here we have volatility down to 10. So literally volatility has gone from the 30s to 10. Right? A massive, massive, massive drop. And it's overall, we are pretty much back to some of the lows we haven't seen since we had those massive rallies in January. Yeah. We haven't gotten close to that number yet, so this is sort of where we are. We're at lower vol. We have SPX moving up, but we still have relatively lower vol. So is there a numerical spread you look at between the VIX cash and futures? Yes, there is, Taylor. Yep. I actually walk you through all that and why it is. But there is. So when I send out my vol newsletter every day, it's the first thing I tell everybody. Where is it? What's the ideal trade? Every day. It's kind of boring. It's not super exciting, but that's what we do. All right. So what you're doing is you're always positioning for where the vol is and where it should be going. And what that does is that helps you create vol trades. It helps you trade VXX, which is what you're here for. Okay? So, Mark, what is the VXX?
What is the VXX? Well, the VXX is... so the VIX is a constant option with 30 days to expire on the SPX. So wouldn't it make sense to have a product that holds a futures basket that constantly has 30 days to expire? It makes total sense, right?
It makes total sense to me too. My gosh. Yeah. It's almost like you've traded it before, the way you explain.
Yes. But, there are some unintended consequences with that basket because it's not theoretical. It actually holds stuff. As that futures contango moves around and converges, it causes VXX to do some funky stuff and causes VXX to fall. However, in the near term, all right, VXX is heavily correlated to the VIX. In the long term, it is not. But in any given day, it is driven by VIX. So, the best way to describe it is that on a day-to-day basis, whether if VXX goes up or down, that will be determined by the VIX. On a month-to-month or year-to-year basis, the performance of VXX will be determined by futures term structure, and that is it. So that is why you have to understand what VXX is. Andrew?
So here are some facts, okay? VXX buys some futures, VIX futures, in a basket, and it holds them. So imagine probably a lot of you come from the premium selling world and you buy options, and you've probably seen them decay. Like I showed you in the picture before, those futures moving down to the cash, that's decay. So it continues to buy a future and sell another future. So it's constantly, and here's the thing about the product is it is very machine-like in its operation. It buys futures and it sells them. It buys them and it sells them. Every day it sells the term that it owns and it buys the next term. It's kind of relentless. So as opposed to the vol products that crash like SVXY and the short future products, VXX kind of just slowly just eats futures, buys them. That has basically destroyed the long-term value of the product. However, short-term, it creates a ton of interesting things to do. So some things to note, so some full disclosure stuff about how the product works. Barclays, in their 200-page prospectus, can change whatever they want to do with VXX, although they have not yet. VXX will go, the note will close in Jan of 2019, and it will be replaced by essentially a clone VXXB, which I'm sure will become VXX again, in a matter of months or something like that, once everybody's comfortable with it. Another thing to remember, VXX does not buy the VIX cash. It cannot buy the VIX cash. It buys futures. So if you want to learn to trade VXX, you have to learn to price the VIX futures. So when I do or create webinars and stuff like that, anytime I put something in red, you should pay attention to it, because that's something you need to grab out of it. Okay? The one thing about VXX, here's another thing that I'll tell you, is the nature of the product. It's going out of business slowly, meaning it decays away pretty reliably, except from here. See, we haven't even seen these lows yet again. This was in January before everything blew up. We were trading in the mid-20s. And right now, where are we close? 35. So the product still has a long way to go just to get back to where it was. All right, so there's lots of downside available. Okay, if things kind of keep going on how it is right now. But that's the thing. VIX goes out of business slowly, because here, take a look here when I go back this. Right, this was it trading, kind of 37. It was in the 40s here. And just kind of that long trend that just kept dying and dying and dying and dying. And it lost about 40% of its value in a couple of months. Okay, it was pretty catastrophic for the product. But all of a sudden, the vol futures went up again, and it's back to life. So it has a very unique and distinct nature, which you'll learn. Okay? Mm-hmm. So this is part of the reason why, is because it rolls these futures. It buys and sells the front 2-month ordinary futures. So, and this is another important thing, so that on expiration, which we just had, okay, VXX is 100% or was 100% June on Wednesday. So all the value of VXX is tied up in the June futures, which it owns. Now, here, when I wrote this a couple of weeks ago, this was on the 8th, at the time, it was 70% June and 29% May. What this does is this creates a lot of interesting trading opportunities, because the stuff that drives the value of the product, right, these future baskets, move at different speeds. So once you learn how to trade them and understand how they work, it actually becomes a great trading vehicle.
Yeah,
because it does predictable stuff.
Because the VIX futures positions create the math behind how VXX moves.
Wow.
And we have,
really
believe it or not, we have some pretty nifty spreadsheets we use that give us the exact calculation.
We do.
All right, after you, Andrew.
Stuff that makes it a lot easier to predict where it's supposed to go, and then you can price a trade on that.
Correct.
So if you think about it, if you knew something was going to drop $4 in a month, would that change the way, or likely would drop $4 in a month, would it change the way you traded the product? My answer would be yes, that would change the way I'm trading the product, because now all of a sudden you're bending something downward. Or if I said predict, or if I said I'm pretty sure that this product is going to go up $2 in a month, would that change the way you trade the product? Mm-hmm. It would me, right? So that's what we learn to do. So the 2016 market was a great signal. Okay, the option pit method is learning how to find edge in any product that you trade. So we specialize in the vol products, in SPX and the indexes, ETFs, and equity option contracts, teaching people how to find edge with volatility. That's what we do. We're pretty good at it. We got a lot of clients that seem to be very happy. The thing is, you got to do a little bit of work to learn how it works, but not a ton of work. But you got to do a little. So what we'll teach you: how to estimate fair value for the VIX futures. Probably the most important thing the course will teach you, because you can use that to trade anything else. And the reason why is it will help you with estimates of what the market might be doing. It really narrows down the range of things can happen, or it makes the range enormous. Okay? I try to trade spreads on the VXX options, but the skew is very weird.
We'll answer that at the end.
We will answer that at the end, but I'm not going to disagree with you. How the path of the VIX predicts VXX moves. Okay? What are the best times to trade VXX? So once you learn 1 and 2, you can start to learn what the best times to trade VXX, right? You want to trade it when it's going to move. Right? Why trade a product that's not going to move unless you want to sell contracts on it? The problem with selling contracts on VXX, like Petru just said, is the skew is really weird. It doesn't really give you great short option contract spreads. What are the best long and short trades? Yeah. What?
We're going to teach you that.
Yep.
When to go long, when to go short, and how.
Exactly.
And then we're the cousins of that, which are UVXY and SVXY.
Why they might be interesting.
Which they are.
But it's the same skill. So if you understand how VXX works, you can understand how UVXY and SVXY work as a vol product, but they're all just a little different. Okay? Boom. So the problem that probably, and this is the stuff I see in a lot of chat rooms and a lot of Facebook rooms and stuff like that, is I am amazed, okay, still amazed to this day, that people will plunk down serious dollars and not have any clue of how the product works. Like, it shocks me to the core. So one of the things that you're going to learn is you're going to understand how the product works. So, and you're going to understand how the vol products work in general. So what are you going to learn, right? Trading VXX, this is the stuff that makes it work. You have to understand VIX cash and futures and how those work. You have to understand and really get the implied vol in the VXX. So that's the stuff in the options, the implied vol in the options. Contango and backwardation, that's kind of what the future curve looks like, how it's tilted. And what edge is in the contracts. Where edge is in the futures and where edge is in the volatility in the product. Right? And we actually go through the math of showing you what that is. And again, to Petra's question there.
The skew is derived actually from hedging and what VXX is actually for. And that's the key that you need to understand.
So you're going to use the skew in the right way.
Yes.
You don't want to use it in the not right way.
You want to use it correctly, not incorrectly.
So you can get an optimized VXX trade for any given day of the week. That's what you're going to learn. So sometimes an optimized trade is no trade. Other days an optimized trade is, wow, I want to buy a bunch of those puts. Other times an optimized trade is, I want to buy a bunch of those call spreads. Okay? And how do you do that? You do it like this.
You buy this. All right, so our easy series starts next Tuesday. It is going to be 4 classes, each an hour, 1 to 2 hours long, knowing Andrew, closer to 2.
Not untrue.
No one will ever criticize Andrew for lack of depth, other than intellectual.
What they say is, wow, it's just really long.
Yeah, it's going to be really in depth, and what we're going to do is light the path of VIX to predict VXX moves. So we'll walk you through the actual mathematics to predicting VXX moves. Now remember, predicting, it doesn't mean telegraphing. It means predicting. Nothing's certain, but we'll be able to really show you where edge is in VXX moves. We're going to teach you to execute VXX trades at the best time, when to buy, when to sell options, when to buy options. We're going to help you master when to go long and short VXX. When do you want to own it? When do you want to be shorted? There are times where it makes lots of sense to own it. And then we're going to teach you how to trade their cousins, which are UVXY and SVXY. Now, if you sign up before tomorrow, all right, I'm going to give you two things. All right, I will give you 1 month of the Volatility newsletter, all right, for free. And I'll talk about what that is in a second. And about 3 months ago, we did a series called the VIX Made Easy. And we will give you that. You can spend, 5, 6 hours over the weekend going through that to get yourself ready for the VXX Made Easy. And I'm going to give that to you for free as well. So all told, we're talking at about $800 worth of stuff. And I'm going to sell it to you for the inexpensive price of $197. It's a steal, people. And you go to optionpipmembers.com/easyvxx. And the other nice thing is if you scroll down, on this page is where the replay of this webinar will be. Isn't that lovely?
I think it's extremely lovely.
Yeah, so now you're saying, all right, well, great, I get 2 educational things and this Vol newsletter that I know nothing about. Well, what is a Vol newsletter? It is a letter that we put out, authored primarily by Andrew. We put out 1 to 2 really good trade ideas a week.
And several day trades.
Yeah. And a few day trades here and there where there's something really good. And but there are swing trades that can be done over time. It does not require you to be
exactly. Most of the trades are like a 2-week hold time is what we're looking for.
Yeah, and it generates actionable ideas that make money over time, and have so far through all of this garbage that we've been dealing with the last 3 months. In addition, once a week there is a live class with Andrew where you can ask questions, and he'll walk through how exactly everything that he's doing and why, how the different trades are working, and how you can make money at it. And what I want to point out is since inception, which was what, February or January?
February 5th, almost the vol apocalypse.
All right. So basically over the last 3 months, he's had 15 trades, 12 are winners, 3 are losers.
So
and yeah, and it's got a nice net positive P&L. And that's the beauty of it. On margin, it's up well over 100% on the year, which is nice.
It's not too bad.
So in 3 months, it's up 100%, better than 100%. If you want track record stuff, I'm sure we can put that together.
Yep. Just ask me for my spreadsheet.
Yeah, and would you? And if you have a question, now is the time to ask them. We're here to answer any questions about. We'll spend a couple minutes answering questions about what we just covered, and/or the course, and then we'll let you all run. Because I know at 10 Eastern, Andrew turns into a pumpkin.
I do.
So do we have any questions, folks?
I think everybody's bowled over by this. I think everybody's totally bowled over. So you made money on the 10 trades based on time decay. Nope. You're not making any money on time decay in March and April, Petru. None. You're not.
No, most of the money is made in what we call convexity. After the first month, it will be $97. You can quit at any time, But we feel pretty strongly you won't want to.
Nope, nobody's left the newsletter yet.
Not a one.
Not a one. The newsletter is depends if you're an option pit member or not.
Yeah, it's $97 a month.
$97 a month. If you can't make $97 a month trading the newsletter, then
well, you need to know what you're doing. Then Petro, this might be a really good course for you.
Oh.
When the VXX ETN expires, the info from the Easy VXX should apply to the new product. Correct. Because what they're going to do with the new product is basically, because the new product is called VXX B, and then when the old product expires, they're going to drop the B, and that will become the VXX. It is the exact same product, exact same structure, just a much further expiration date on the credit.
Right, and Petro said, he's saying, oh, I trade a lot of flies and cows in the SPX, but they don't work in VXX. That's because it's not the same product, Petro. It's a different underlying. You got to trade it differently.
And it's not that. There's other things, Petro. Is there a separate newsletter for VIX futures? No. We do some VIX, VIX within the vol newsletter, but it's mostly options and not futures. But you could apply, a lot of the thought process to VIX futures, for sure.
Yeah. Because remember, the whole methodology behind this is understanding how the VIX futures work first.
And like we said, you're going to get a month of it free with this awesome course. So, you know, what's the harm of trying to make money on a newsletter that has a pretty good track record?
The track record's even better if you started, because I launched an option pit in the pro room in October, and for option pit members in general in January. So I think it's like we had 35 trades and 6 were losers and 29 were winners.
Go us.
Go us. You can ask anybody in option pit, by the way. We'll be happy to point you to anybody that's been trading. It's actually kind of a secret now that I think about it.
Yeah.
It's a pretty good one.
All right. Any other questions? Do the VIX futures fall in a rising rate environment?
Yes.
Yeah, they can. Yeah. They can also rally. How many legs in the options trade? It can be 1 or it can be 3. It can be 1 or as many as 4. 4.
Because you could trade like an iron condor or a fly and then hedge with a vol product.
So are you always delta neutral or are you directional? The answer is both. Sometimes we're delta neutral, sometimes we're directional.
Right. It's usually normally though, it's very delta neutral.
Yeah, sometimes we'll have a little lean bias usually.
It can lean in a direction for sure.
But, you know, the way we structure it is that if we're wrong, we quickly become right. Most of our positions apologize for doing wrong.
Exactly. Well, what my rule is, I don't like to be wrong for a lot of money.
Exactly.
So you want to be, the only way you really cost you money in our vol newsletter is if you really go heavy, you know, and like double or triple a bet in a direction. Then it can cost you money.
You will not be. There is some adjusting. So the question is, do you do a lot of adjusting? There's some adjusting. Then Jim asks, will this teach me everything I need to trade VXX on my own, or will I be dependent on the newsletter? You will not be dependent on the newsletter.
Nope.
We do not. The newsletter is meant to help you become a better trader and generate some ideas.
Right.
But going through the course, you should be able to. You should have the knowledge to develop your own trades. What's the point of doing an educational course if you don't learn how to do some stuff on your own?
Do you do a lot of adjusting?
I'm not teaching you to fish. I'm not going to give you a fish. I'm going to teach you to fish.
Right.
You know?
Do we do a lot of adjusting? We close. You got to close positions.
We're closers. Closers get coffee. Close.
You have to go take the money.
Yeah. Like we said, it's about 2 weeks. All right.
About 2 weeks. Sometimes, But what I do is I do put the duration of the trade in. So there will be sometimes we have like a 3-day strangle.
Yeah, if we can get something done quick, if we make a lot of money fast, it'll be short. If we make money the way we expect, it'll be longer. Right. And I think we'll have time for one more question, and then we'll let everybody run.
Yep.
All right.
You got a lot of questions. Try it out. If you don't like it, market will fund your money. Can't lose. It's that easy. Like I said, nobody has dropped out of my newsletter yet.
All right. All right, everybody. Hope everybody has a great day and a great evening.
And I'll talk to you Tuesday.
Yep, we'll see you Tuesday. Have a good one.